In the midst of soaring bond yields, a financial tempest is brewing, leaving investors and economists alike in a state of unease. The epicenter of this fiscal storm lies in the United States, where bond yields have reached a staggering 17-year high, casting a shadow of uncertainty over the financial landscape. This tumultuous turn of events follows the Federal Reserve's resolute decision to maintain higher interest rates, a choice that has sent shockwaves through the global economy. With the 2-year U.S. Treasury note yield surging to an eye-watering 5.2% and its 10-year counterpart inching perilously close to a 16-year high at 4.5%, the aftershocks of the Fed's move are felt far and wide. This surge in yields can be traced back to the unprecedented interest rate cuts of 2020, a response to the harrowing onset of the COVID-19 pandemic. In the wake of this crisis, investors sought refuge in the safety of treasuries, sending their prices skyward and suppressing yields. But now, as the U.S. economy flexes its muscles and a tight labor market fans the flames of inflation, the Federal Reserve remains committed to its policy of tightening the reins on interest rates. The question that looms over investors and policymakers alike is whether this upward trajectory of rates will continue unabated, potentially spelling further trouble for bond prices. As markets brace for the possibility of an even higher federal funds rate and fewer rate cuts in the future, the financial world finds itself at a crossroads. Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So, before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. The world of finance stands on the precipice of a new era as bond yields soar to heights not witnessed in 17 years. The catalyst for this dramatic climb is the unwavering stance of the Federal Reserve, which, at its September policy meeting, decided to maintain higher interest rates, sending shockwaves through global financial markets. This pivotal moment in fiscal history has led the 2-year U.S. Treasury note yield to surge to a jaw-dropping 5.2%, marking a 1.4 percentage point increase since May and reaching levels not seen since 2006. Simultaneously, the 10-year Treasury note yield is edging ever closer to a 16-year pinnacle at 4.5%. This abrupt surge in bond yields can be traced back to the aftermath of the COVID-19 pandemic. In response to the economic turmoil unleashed by the virus, the Federal Reserve initiated a series of unprecedented interest rate cuts in 2020. This move prompted a rush of investors into the safety of treasuries, driving up their prices and, in turn, suppressing yields. It seemed like a haven in the storm. However, the economic landscape has shifted. The U.S. economy is displaying remarkable strength, with a tight labor market stoking the fires of inflation. In light of these persistent inflationary pressures, the Federal Reserve is poised to continue tightening its monetary policy well into 2023. This has cast a shadow of uncertainty over the bond market, as investors anticipate a higher peak in the federal funds rate this year and fewer rate cuts in 2024. The prospect of rising monetary policy rates is not limited to the United States alone. 38 central banks worldwide are reporting their highest rates since 1995, when adjusted for gross domestic product. For investors, navigating this treacherous terrain demands careful consideration. Experts are advising them to secure current yields through instruments like treasuries or bank certificates of deposit. Despite potential short-term increases, bond yields are expected to be significantly lower a year from now. The Federal Reserve's path suggests a gradual easing in response to progress on inflation and indications of slowing U.S. economic growth. This may not necessarily involve immediate rate cuts, but could signal that peak rates for this cycle have been reached. Historical data indicates that the 10-year yield tends to peak a few months after the Federal Reserve's final rate hike. This crucial moment could occur at the Federal Open Market Committee's November or December meetings. Meanwhile, Other international central banks, such as the Bank of England, European Central Bank, and the Swiss National Bank, appear to have halted rate hikes, while countries like Brazil and Poland are already reducing their interest rates from recent peaks. Amidst the backdrop of the largest increase in bond yields in decades, the stock market has paradoxically seen a rally in 2023, driven by expanding valuation multiples. However, the specter of higher interest rates poses a lurking danger to stocks, while offering the promise of rising bond prices. In the event of an economic downturn that necessitates rate cuts, corporate earnings may falter. Therefore, increasing bond exposure within a portfolio today can offer an attractive return rate and diversification, thereby adding a stabilizing force to investors' holdings. In a world where financial stability is increasingly elusive, how do you envision your investment strategy evolving to weather the storm of rising bond yields and shifting interest rate dynamics? Share your thoughts in the comments section below, and remember to subscribe to the channel to stay up to date on global economic news. See you on the next video, and please like and share if you enjoy our content.